All right. Good morning. Good morning. How's it going? How's everything going? You guys making money? Making lots of money? All right. Yeah, it is kind of crazy. Making 200%, oh no, 600% return in a day. Probably you find a strategy or a flaw in the system, which is good. One important thing about this investment world is you observe the pattern, identify the pattern, and you try to make a living from that pattern. And I hope that living is not your primary living tool. Treat that as your secondary living tool. So what I'm saying is, even if you win $1 million, win $1 billion, win a lottery, continue to work as in the past, and try to enjoy that extra wealth. But never ever use that extra wealth and use that as a primary tool. That hey, I can win another lottery. No single person, no such person can like win a lottery like more than 2 times in his lifetime. Of course, like you heard someone actually do that, but usually these people will not have a happy ending. Anyway, the entire investment course that we are doing here is for you to learn something about finance, but hopefully one day you can use this and apply to your personal wealth, management. And I hope well, this is something that you can take away. So please do participate in the market watch, and I know that some students still have not participated for some reason. So I see a lot of trades here. That's good. And but some of them, including myself, I do not have such time to actually participate. But try your best to do that, because in your assignment number 2, once again, you need to write down whatever you know, how you feel about the market, and how you make your investment decision. Of course, everything I teach you here in 385F is more for a long-term investment, long-term investor point of view. I'm not teaching you how to do day trading. So this is one thing I want you to be aware of. Again, it is not day trading, but if you are able to find a strategy, a trading strategy that can do day trading, feel free to do so. Of course, I'm not going to block you from making money, and I actually encourage you to do so. But in here, all the methodology that I'm using, all the pitching I'm doing here is for the long-term investing. So I just want to make sure you all understand the this situation. And one important thing is someone actually pointed that out this just now. There's a calculations example here. When you click to this page, you'll be able to see like all types of calculations in finance. Again, I'm not asking you to memorize everything. I mean, in your quiz, in your ICAs, it is about the logic, about the concept. It is not about the calculations. I understand that some of you maybe may not be that good in calculating things. So I want you to at least understand the concept, capture the concept. That is far more important than doing calculation, because for calculation, there are lots of tools out there that help you to do the calculation. So you don't need to actually do that. And for the calculations part, you have done that in assignment number 1. So I'm not that worried to in that case. So there are bonds calculations, options calculation, and then a technical analysis, fundamental analysis, and then bond analysis. This is the bonds, and then there's a maturity, and portfolio allocation, and a fund allocation. So I'm not going to spend more time here. And let's go back to the last part. I'm going to use a few minutes here to wrap up what we have done last week. There are remember this. There are three approaches to evaluate the investment. Three approaches. The first one I'm teaching you is what I'm sharing with you is actually the technical analysis. You use historical data to evaluate the investment and try to make a profit in the future. So that's a technical approach using historical information such as prices, volumes, and etc. etc. And that's pretty much it. The second one will be the fundamental analysis, which we are going to do that today. The fundamental analysis is about a company's financials, industry, their evaluation, and the macro view. When you combine all these different factors, and then you make a judgment. So this is the fundamental approach. And then the last approach is called the behavioral finance, behavioral approach. It is a very interesting subject because no one can actually quantify this behavioral approach. And I will explain to you in a few minutes. So last week we talked about how you can use technical approach to make a guess, to make an analysis, to make a projections for the future price. And for the technical approach, there are usually two major themes. One is about the indicator. Second is about the pattern recognition. As I said, the key for you to succeed in your career, in the investment, or anywhere else in the world is about pattern recognition. Do you know how Newton, Isaac Newton, or Albert Einstein, or even John Hopkins can actually win a Nobel Prize? It is all about pattern recognition. If you're able to observe a pattern and then quantify it, formularize it, if there's such word, make it into a formula, a mathematical equation, then you are able to win a Nobel Prize. And that's it. That's how easy it is. Or even Nobel Prize, if you want to get a PhD degree, this is how you're going to do it. You run a regression model, try to apply a formula into a phenomenon. And that is pretty much the technical analysis too. And so think about this. When you let me, I don't know how many years ago, maybe 700 years ago, or 2,000 years ago, Pythagoras theorem, a squared plus b squared equals c squared, right? That's the triangle formula, the right triangle formula. So that is the some observation, the pattern they recognize. So this is something you can think of in the technical analysis. How you can use historical stock information, stock price, closing stock price, and let's say volume, combine it together and then make a judgment. So indicators and patterns. Whoever wins, win the game. Can you apply that in your career? Yes. It is very, very applicable. So remember my words. When you go out to work one day, the first day you go to work, you walk into the office. The first thing you want to do is identify who is the boss. Who is the boss as the second person, and who is the boss, like the favorable personnel. And then observe what they do usually in a routine. Do they like come into the office early, or do they like stay late in the office? Do they eat lunch outside? Try to be with them. This is how you learn the pattern. If you are able to copy their mode, that's good. For instance, when I was at JP Morgan Investment Bank, when I was doing a pitch book, so it's some kind of presentation of bank book, what should I do? I copy last time's whoever was the best analyst last year. I copy his bank book and then apply it in my deal. And then when the let's say the vice president or managing director saw that, hey, this is good, this is the entire outline is good, because I just used the template, right? So copy the templates, copy whatever is useful, whatever is the best out there. Make it to your use. Of course, this will not be considered as a plagiarism. As I said before, if you're able to copy our number one's highest returns students, your classmates, feel free to do so. There is no plagiarism there. But in your paper, let's say assignment number 2's paper, of course you cannot copy that. That is the only chance that you cannot do. Of course, in the exam, in the quiz, you cannot do. The technical approach is about the pattern recognition, and of course, like there are lots of examples here, indicators such as RSI, relative strength index, could be the breadth, Bollinger Band, and Triangle statistic, and then all these things. So I'm not going to go into this, but for those who are interested in the technical analysis, try to read through not this particular PowerPoint, but the one that shows here, 5B. I spent, I think, at least an hour to show you this particular technical analysis. And this is, I grabbed this from the European Investment Bank, so Credit Suisse. I grabbed this from Credit Suisse head of technical analysis trading desk, and they have this PowerPoint, and I grab all the useful information and share that to you. They have much comprehensive and a professional point of view how you should do technical analysis. This is much better than the one. If you guys remember the first day you were in here, the guy, the CIO, the Chief Investment Officer from the television, he was the guest speaker, and the way he used the technical analysis was just like kindergarten. Don't do that. You can actually do better than him. So try to learn the appropriate way, the proper way, the professional way to run the technical analysis. So this is how you should do it. Of course, all these are not in the syllabus and not in the textbook, because this is actually much more advanced. But for those who are actually interested, try to study in this lecture 0505 boy. Again, I list out very clearly. You can see 4 is about the behavioral finance, which I'm going to cover it now, and then 5 is about the technical analysis. And so 5A is something that you need to read through, but 5B is extra out syllabus materials. And I have a lot of that. And then of course, like the extra reading. I hope you guys will read it. We'll read it because it's going to be helpful to you. So let's say we are going to number 4A. So today we're going to talk about behavioral finance and also fundamental analysis. Behavioral finance, I probably will spend like 15 minutes to do this because it is not that useful, first of all, and the second of all is it is hard to be more applicable, because anything that cannot be explained from the technical standpoint, from the fundamental standpoint, then you can push that to the behavioral standpoint. So this is a very easy. Again, 3 school of thoughts: technical, fundamental, behavioral. Technical, fundamental, you can explain. Behavioral, you cannot explain. So this is how it works. So for behavioral finance, think about the emotion. So and everything about behavioral finance is about emotion. And the good thing about behavioral finance, which I liked a lot when I was in my MBA program, I tried to register for the course. The course for the 2 years I stayed in Berkeley is always full. So I cannot register for that course. So what I did was I just like sit in the classroom, didn't even pay for the tuition, but I sit in and listen to the professor what he said. But the class was always full because the class size was like 30 or 40 people, but there are always like 60 people inside. So people are sitting on the floor, and the professor was fine with that. So we don't care about that, and we just want to learn what he said. So this is how crazy it is about the behavioral finance, because it's about the psychological behavior of a human being. how logic are you? So let me the one good thing about this particular course is that it didn't tell you how to make money, but it will tell you and it will try to explain to you why you lose money. And this is my favorite part because hey, you make money, that's good, that's fine, but I'm sure I'm here to tell you my mistake, my problem, my issue. Hey, I'm not trained for myself to buy 10 cents at $600. And I actually did a lot. $600 I bought a lot, $500 I bought a lot, even $400 I bought a lot, and I'm still holding 10 cents. That was one of the well, not the worst, let me tell you this, and that is not the worst investment I've ever made. When it dropped below $300, do you think I bought anything? And the answer is no, I didn't buy anything. When it dropped below $300, I didn't buy anything. So that was that is actually a problem. It's a psychological problem because my thought is like anchor at $500, at $600. When it dropped to $300, if my valuation is correct, then this should be a good buying because a good buy timing, right? But because my emotion override my my rationale, and that is the bad thing about the during the investment decision. So I'm going to show you more examples here, like maybe there's some here and there example, and they try to use some terms, psychological terms, to describe to you why that is. So back to the very part is the EMH, efficient market hypothesis. I spent a long time to talk about this EMH, and I hope you guys understand what EMH is because you probably will see this in the quiz about the logic. So in this case, EMH says security prices are property reflect whatever information available to investors. So price reflects everything, and that active traders find it is hard to outperform the passive strategies such holding the market index. So it is hard. So there is a whole bunch of assumptions here, and the most important ones is the last one here. Behavioral finances assumes investors are not rational. That is the key, are not rational. So and the second thing is tests of market efficiency have focused the performance on active trading strategy. So if in the EMH, if you believe you can actually make money in that particular market, then it will be reflected in your active trading strategy. So that's another thing. And lastly, the key for behavioral finance, we assume investors are not rational. So for tradition, for behavioral finance, there is one side which is the traditional finance, and the right hand side one is the behavioral finance. The traditional finance, we will think about, hey, what if investors don't behave rationally, and then there won't be any profit taking, free money. There won't be such opportunity. But for the behavioral finance, they believe that the price is correct and everything is allocated efficiently and consistent with EMH. So this is the difference between the traditional finance and the behavioral finance. So behavioral finance, they assume the price is everything, right? And there is a problem. People will criticize. The first one is the investor will not process information correctly. That is one thing. When you present an information, you and me will process the information differently. I may process that in the wrong, or maybe underestimate something. Maybe you will be the right one to catch, and I may be the one, the correct one in the second case. So it really depends. So not every single investor will process the information correctly. So that is the first a problem with behavioral finance. The second problem is investors. They very likely to make inconsistent and suboptimal decisions due to emotional biases. Just like my 10 cents, I anchored to that particular stock. I hate that. I lost so much money, and I should actually even cut it, but I didn't. I should reload it. I didn't. So all these decisions are considered to be irrational and suboptimal. But then, hey, people like me, even for more than 20 years of experience, I still make that kind of mistake. So behavioral finance is not something new, but it will always be there. So I was actually talking to someone. Well, actually, it was my boss. Yesterday, that was actually yesterday. He was asking me, hey, can you apply the AI, the artificial intelligence technology into our company's decision making? I said yes. It is a marketing gimmick. You will see a lot of TV advertisement or on the bus, on the public transportation about the AI info. The first securities firms in Hong Kong, they said that, hey, we are going to use the ChatGPT in our decision making. I said, screw it. You know how reliable ChatGPT is. It is still a very immature product, even though they know a lot of information. But then, if I said that the financial market or the stock market itself is actually a random walk, then how can artificial intelligence predict the stock price or even give me an advice on that? So that is a problem. So think about this. When we do behavioral finance, we have to think about, hey, there are a lot of human emotions. You guys remember a few years ago, there was the world champion chess player playing against the Apple supercomputer. Do you know what the result was? Eventually, we lost. Human being lost. Our world champion lost to the machine, but it was a 2-1 loss. So what happened was, in the first round, the computer win. The computer wins. So it won. I don't need to say it because it was good. But then, do you know what happened in the second round? The world champion in the fifth or the sixth move, just at the very beginning, in the fifth or sixth move, suddenly make a very irrational move. It was totally out of the chart. And then from that move forward, the AI was totally screwed. He didn't know what's going on, and he was actually acting like a child. He was so angry, and he was actually making all irrational moves later on. It was described as just a crazy kid, like someone who doesn't know how to play chess and then just makes a random move. Because of one irrational move from a chess player, and that is screwed the entire AI. Imagine there are more than 1 billion investors doing like crazy stuff every single minute, every single second. Do you think our first version of, or not first version, but the fourth version of ChatGPT can actually incorporate human psychological, emotional behavior and then make the right decision? Or maybe I'll make the right prediction? Obviously, it's not. So whatever you see in the market, I'm not saying that I challenge that security firm, but I would say, hey, the entire technology is still not mature enough, and our human brain is actually really crazy. You tell me that I should actually load up the 10 cent at $200, I did it, but I'm buying that at $500. It doesn't make sense at all. But actually, I did it. I did it in the last 3 years, and I'm still holding 10 cents. So this is a kind of crazy. And another thing is one important topic: linked REITs, 零级. So you heard that 2 weeks ago, they have the right offering, right? A lot of people are selling the shares. To me, this is like absolutely crazy, absolutely irrational. Because there is no way you can, well, people said that, hey, whatever you invest is sunk cost and you have to look forward. But then at the same time, you are given an option to dilute your shares at a discount price. Why do you not participate in it? 67% of institutional funds pretty much will participate in it. And you believe you can outrun the smart guys over there in the game? Well, it turns out that, hey, you may not be that smart at all. And in this case, irrational decision making dominate the market. Even ChatGPT may recommend you to participate in the right offer, but then at the same time, are you going to do that? Probably not. So I don't know. It is still a very immature technology, and how are you going to implement that? It is quite different. But whatever you see, the company is trying to tag along. Oh, we are doing the ChatGPT, we're doing the AI thing. A lot of that is actually marketing gimmick, just like the ESG. Our company is running the green bond, running a green environment, good to the society, good in the governance. I mean, it is just a marketing gimmick. But how many firms are there actually participating in it? That is always a problem. So in the behavioral finance, make sure you understand that you always have a weakness, and your weakness is inherent in ourselves, Homo sapiens, in our brains. There's no way you can avoid that, but you can not avoid it. You can minimize it. So try your best to minimize the suboptimal decision making. So let's go into that. So what is the meaning of information processing? Very easy to understand the concept. Limited attention, overconfidence, underreaction. To me, I hit all 3 points. I pay pretty much like no attention to my 10-cent shares. I underreact on 10-cent shares. I should react on that, and I overreact on some other stocks. So that is a problem. And do you think you're overconfident? Yeah, sometimes you do, because when you make money in particular, then you'll believe that, hey, you're on top of the world. You know, you got some strategy going on, and that is good. Maybe you're good, but maybe you're lucky. So always believe that, hey, when you achieve a good return, try to think about the entire decision making. Is it the right decision, or is it just a tag along with the market, and you were just lucky? So make sure you understand what is the information that you get. Is it the information? Is your analysis correct that makes you make the money? So this is very important. Overconfidence, and I always overconfident with my decision. So so all these years, I trained myself to be very conservative, and it goes to a point that it is way too conservative. So in all my investment decision, usually I will not participate in like really high growth stocks, and I don't like those stocks that I don't understand. So because I try to avoid this overconfidence, that's the accumulated experience from my early years. And then, of course, extrapolation and pattern recognition. You will say that, hey, you said that, hey, pattern recognition is good, right? I said, yes, it is good, but then you always try to find the logical reason behind, the rational reason behind. Sometimes, and especially then TV commentators, he was using a representativeness bias. Whatever time horizon he was using, are you applying the same time horizon? He doesn't even care about is he reading a 5-minute chart or 5 months chart or 5-year chart. That will give you a totally different perspective. So the pattern recognition, it could be wrong because you process the information wrong. So make sure you're aware of that. Again, there is no right solution for you to fix all this problem. What I'm trying to tell you is you try to think about this all the time and try to minimize it. There's no way you can actually fix this or avoid this. And then there are different types, and of course they use different names. And you can actually try to read through that. Sometimes it's a mental accounting, and when I said mental accounting, it is what I had. Let's say I have a particular stock. I can't remember what that is. Oh, okay. I use the Link REIT. Link is actually another stock I invest. I actually bought it around $80. 80. It is trading 53 right now. So should I sell it or should I not sell it? Because I anchor my emotion at $80. Anything below $80, I'm not going to sell it. That will be a problem, because when a situation comes in, so because I bought Link REIT 3 years ago, so that was trading at $80. If the property market is actually not doing good after the COVID, I should actually sell it right away at $70 to avoid a lot of losses, right? But because I anchor at $80, at $70, I'm not going to sell it. I'm not willing to sell it. And I keep persuading myself that Link is a good company that can actually go beyond $100. And I still keep that in mind. That is the problem. That is the mental accounting. I have that historical cost. That's not good. So anchoring or fixing to a particular historical price. That is one type of behavioral finance, one type of human weakness. And I'm sure that every one of you here will have that. And of course, regret avoidance. Regret avoidance is also something that will trigger a lot of improper decision making. So when you regret something, which means that, hey, you have fear of missing out. This is actually a very popular word right now in the market. FOMO. So FOMO, fear of missing out. Have you read the news? FTX, probably you know this, a particular giant firm. FTX is the cryptocurrency exchange. The CEO got caught by the FBI, so now he's in prison because it was one of the one of the largest FTX exchange, one of the cryptocurrency exchange in the world. Even our treasurer, Hong Kong treasurer, Paul Chan, actually invited him in last November. So basically, like it was 4 months ago, last November, to present to us. He was the first guest speaker to present at the FinTech Week. So you heard about the FinTech Week even from news. He was the first to presented to present in Hong Kong to do that. And then in a matter of weeks, he was caught by the FBI. He is now being criminally charged. That is a big problem. Did anyone check his background? Did anyone check the financials? No, no one really cares. Fear of missing out. You just like push that out and then don't care. Invite him over, and because he is the CEO of the biggest cryptocurrency exchange, no one cares. So fear of missing out is indeed one of the problems. And this is I guess this will be a new term of the behavioral finance. Will this happen to just the normal citizens like us? No. It happened in sovereign wealth fund. Do you know who participated in FTX as well? Singapore Sovereign Wealth Fund. So it was actually my sort of the peer competitor. I was working with the Chinese Sovereign Wealth Fund, and then the Singapore Sovereign Wealth Fund participated in FTX. They wiped out the entire investment. So they participate in FTX for $250 million US. Now it's go down to zero, nothing. So they declared it as a loss, total loss, 100% loss. That is a problem, right? You spend $250 million in that particular exchange, and then now you get nothing. Do you know, if I'm the boss of the Sovereign Wealth Fund, do you know what I'm going to do? I'm going to fire that analyst, the portfolio manager who recommend or who push the money, put the money in the decision. That is like the most stupid thing I've ever heard from a sovereign perspective. But even at that level, people are fear of missing out. That is always a problem. So it is not just happened to us, the individual or retail investor. It happens to even a profession, fear of missing out. And it's not particularly in the last few years, a lot of investors actually got feared of missing out in this case. And of course, and the utility function. So this is only chart that I can show you. From a traditional finance, a conventional behavior, the utility function is quite normal. You can see the upward sloping curve. But then the utility function for prospect theory, the behavioral finance, it is different. Because when you have change in wealth, the more money you have, then probably you're not going to take a lot of risk. But then if you're in the middle range, which is around zero, then you're going to take a lot of substantial risk and hopefully asking for substantial return. But then when you have no money, going down to the negative change in wealth, then your decision making will be affected. So this is quite different from this chart. This is the only chart that can show you the mathematical situation. And I'm not going to go into like details here. One terms I want to put in is Keynes theory. So Keynes. So he is one of the most famous economists in the modern world. So Keynes economics. So he has a particular school of thoughts to describe the current economy, and he is actually pretty consistent with the current phenomenon. But he says one thing about the stock market: markets can remain irrational longer than you can remain solvent. So always remember this, because I remember back in 2009, that is a very important key. So for you, whatever you want to take away in this lesson, remember this particular word. Markets can remain irrational longer than you can remain solvent. What is the meaning of solvent? Solvent means you are still having the money. If you believe that, hey, the market is going down, I should keep my short position and I should buy more in the market. No, you're wrong, because there's another theory. I can't remember it's Moses theory or Morse theory. Whatever you expect, the outcome will always be only 30% of what you expected. So the outcome is always going to be a negative or not as expected as you can think of. So if you have that kind of logic, no expectation, expects nothing, is the best way to handle the future. So in this case, don't bet on the market that you will pick up your wealth and you're making you can recover, because sometimes the market can remain irrational like for a longer time than you can think of. The intrinsic value, the chart on the right hand side, is actually what I have been using to not educate, but actually to explain to my boss in China and Beijing all these times. I always explain to them that there will be intrinsic value. My calculation, my valuation, my analysis will be like not a straight line, of course, but there will be a line here for the companies, for the investment growth. And then there will be times that will be the company stock price will be over the current price. I'm sorry, the current price will be over my target price. And then there will be sometimes the current price will be lower than the current price. So what I usually do will be something like this. If my target holding, it's about 5% of the portfolio value, I will likely to hold 4.5% most of the time, or close to 5%. But then when the stock dropped quite a bit, I may hold 5.3%. And then when the stock was higher than I expected, then I will drop that down to 4.8%. I'll leave some cash with me so that I can actually move around. And how I move around will be the over and under price period. But then the problem is you have to have a really high conviction, high confidence that you're able to you're correct at this intrinsic value line. Extremely high conviction. If you don't have high conviction, if you don't have bad confidence, then everything here over or under period will be incorrect. So that is a problem for the intrinsic value. And of course, in terms of the entire behavioral finance, a lot of assumptions that they avoid is that they don't have the transaction costs, implementation costs, the model risk, and how accurate you think about the entire model. So I'm not going to go deep into that. And then when you see, hey, two similar companies, how come there could be some differences? There's always differences. You guys heard of the A share and H share differences? AH 无差别. Same company, they are basically the same company, but then it's trading slightly different. The A share is trading at a discount. Always trading at a discount. The H share is always a higher premium. Then this is very simple, right? I mean, you short the you short the H shares and then you buy the A share. Yeah, but then that premium always exists. Are you able to capture that premium? No. It will be extremely hard. The same chart here is the Shell and also Royal Dutch. So these two companies are from Britain, from UK, United Kingdom. Also, they also belong to oil and gas company, oil and gas sector. The price difference could deviate quite a bit. Of course, there's a problem with these two companies, and the thing is that two companies are in the same industry, but it doesn't mean that they have the same management execution, management strategy. And this will go back to the fundamental approach. So there will be some type of discrepancies there, and cannot be captured by the market completely. And that will be the again execution, management execution issue. And then there are some other situation, and it is actually quite hard. So the first one is equity carve out. When a listed company spin off another company, so you have A plus B. That should be equal to A plus B, right? But no, it is actually A plus B plus C. There will be another part, another value, extra value coming in. Do you think you can participate in arbitrage? Yes. But will the market be rational to reconcile this difference? Most likely, it is hard to tell, because sometimes the market will recognize that, but sometimes it doesn't. I have that experience before, because it was actually one of my major duties to calculate sum of the parts. So SOPT, SOTP. Sum of the parts, when you add up together, it should get a higher value than the current price. That is the arbitrage. I short the current shares, and then I buy the stocks. So this is what they call. But does the market rational? It may not be. Another way is the closed-end funds. This is actually what one of your classmates asked this morning. Can you participate in the premium and discount on the NAV? Usually, it will never convert. Which what I meant by that is, a fund will always list out how many shares they have for that particular stock completely. And most of the time, they are trading at a discount. And you said, hey, you're trading at a discount. That's good. I will buy the fund and short the market, short the exact shares, so I can get the arbitrage, right? But no, that particular discount will be consistent for longer than you can think of. The reason, it could be many reasons. But what I'm trying to explain to you is, there can be most likely it will be a discount, but very few of them will trade at premium. But the discount will always be consistent. So don't think that, hey, you find a particular arbitrage there, but try to observe how long that discount has been. So that is the key. And if you remember what happened in the past, back in the year 2000, so probably you have not been born yet, but that was back in the 1995 dot-com bubble. Imagine when you see dot-com bubble, it will be something like AI technology for every single company that you can see in your life, in life. Everyone is having their own AI. Everyone is having their own ChatGPT. And no one can actually make money out from that ChatGPT. And imagine that kind of era. That was actually back in 1995, 1999. The tech bubble burst and all the valuation was like crazy at that time. And I'm talking about like company with no earnings, not even earnings, no revenues, but they are trading on 100 times projected sales multiples. That was bad. And then there's a housing bubble. It was the worst financial crisis in 75 years. That was back in 2009, 2008. It was also about the behavioral finance. People are overconfident and they try to use a lot of financial engineering. We'll cover that in the fixed income section. And of course, at that point in time, it was it's worth if this is the case year 2000, and then it was 12 trillion. 12 billion. If dividend growth rate is 8%, but then it's going to be worth $8 billion if the dividend rate is growing at 7.4%. Can you use this perpetuity formula, dividend discount model, to evaluate the stock market? Yes and no, because you will find something quite different. Because whatever is trading right now, it may be overheated. So before the collapse in year 2022, if you check the SPX P ratio, price to earnings ratio, was trading at close to 30 times. What is the average, you ask? The average is only 15 times in the last 50 years. So 30 times definitely is a much higher multiple, but no one cares. And then suddenly everything collapsed in 2002, and everyone wiped out 30%, 40% of their wealth, including the female Warren Buffett, wiped out a lot of asset under management. So that was pretty bad. Anyway, so behavioral finance, I just want to share with you some keywords, some human behavior, some flaws in our thoughts, just to keep in mind that there are lots of irrational decision making that cannot be explained with the fundamental, with the technical approach, but then everything will be pushed to the behavioral finance approach. So when you make a decision, should you follow the heart or should you listen to your head? That is a very key. So which one dominates? So always remember, because in the behavioral finance, it always show you the negative side that you should be aware of, and it will help you in your decision making. Have you done your homework enough? Are you overconfident? Are you following someone's pattern? Are you anchoring or fixing on some historical price? Is your mental mind clear enough to see what's going on? So that kind of thing is about the behavioral finance. All right, let's take a quick break and 5 minutes, and we'll be back at 10:05. All right, and we will go into the fundamental approach. Yeah. Did Eva cover anything with you last time? No. Let me do some announcement, but make sure you attend next week's tutorial session. In the first hour, she'll cover everything that you need to know. So in the first hour, she'll go over pretty much the ICU, and then try to remember everything in class. It's not going to be that bad. But don't worry about this. And I can assure you that not much calculation you need to do. Not much calculation. I don't think that I don't think that's even considered as a calculation at all. It's just a common secondary school formula. So don't worry. And
我有玩过3K，第二次玩过3K。
哦呢個啊，
佢個 trend 永遠都係左下都有，當冇睇到。
有人成日綠燈，有人成日紅燈咁樣，個深度。
random walk
北水咧，
即係北水咧。我呢次係文9點我應該會入。呢啲係變得幾快？變4日，都係拜六日。
咁樣講，我哋有冇關我睇裏邊啲其實就
都好得嘅。
即係你又真我好中意隻文章，不過好憎佢哋股票，好憎佢自己嘅。係唔快法？係嗰個投資啲嘢係你一入咗去就有一世嘅，即係你好難掹翻出嚟。但係我覺得咁樣投資係一定需要嘅，因為我好簡單。如果假如大家都有香港，即係呢度咧，就算你唔喺香港可以做投資人，你有一個叫做香港叫 MPF 啦，叫 Managed Portfolio Fund，有一個退休基金。你一做嘢嗰下咧，你就會入到。咁你每個月可能會，譬如你當你5000零，佢哋每個月就扣你1000蚊，咁佢扣你就繼續擺咗落去你指定嘅基金嘅。嗱，咁嗰個基金上面咧，係啊，好多其實睇你邊間公司，睇邊間同個基金俾你。嗱，個問題就係咁啦，喺嗰度投咧，咁你都要揀邊個基金好喎？譬如邊個基金經理好，咁嗱呢度我就話俾你聽，邊個基金經理好。咁啊，所以你要去睇下究竟係點投。嗱，咁可以好話俾你聽下，不過我又冇，我幫唔幫到呢啲？
你講邊隻啊？想講邊隻？
即係好似
邊間公司？
譬如好似我依家做緊呢間公司，我依家代賣廣告。我間公司依家係 Morningstar 排第一嘅。Morningstar 嗰個 ranking 香港嗰啲嗱，佢唔係一個退休基金嗰啲基金，佢只係出邊買嗰個基金，唔係一啲分，一個普通一個即係當一個 stock fund。咁佢係全香港，我啱先睇到啲，哇，排到第一嘅，幾勁！唔係 OK， 即係就咁 general 嘅一個，即係 Hong Kong，佢叫 prime equity， 即係等好多個基金。因為我都冇做到呢樣，我都係俾其他人去咁掹都出嚟。
我之前咧見到啲科技機構咧，嗰個買息率犀利咧，好鬼勁，1年可以成。
我 stop share 一陣先。呢個就係嗰個分最尾，我哋係最係我都唔知喎，係都係嗰個嘅 L06，我再出，喂，今年之間呢一隻啲話好掂喎，佢話嚇係喎，又咁好嘅咁啊，所以就其實好多唔同嘅基金喺度，你見到譬如左手邊開始呢度啦，有見到海通啦、BOCHK 啦、Allianz 啦、HSBC 啦、Bosera 啦，呢啲全部就恒生啦、東亞啦、Groda 啦、Manulife 啦、 Pine Bridge 咧，個好出名嘅分，咁我哋已經排到呢度，我哋公司個分已經排到呢度。少金融，即係其實但係又咁講啦，你呢個 year to date 啫，即係你講下，即係要5年啊、10年啊嗰啲嘢先得嘅。咁佢依家 year to date 都唔係代表咩嘅，但係呢個我都係因為呢個基金啱新成立，舊年暑假先至咩啫嘛。即係舊年暑假我哋我先開始喺嗰度進行部署。所以我其實想講係咩咧？係你做投資，你去到 MPF 你都要做投資樣嘢，你買樓都係投資一個樣嘢。咁所有嘅方法，所有方法都係同一樣，都係咁樣睇咁樣做。就你好似話有啲地產嘅喺地下鐵度，過嚟買層樓好平嘅依家，我平你又唔買。不過你買橙咩？買橙我買啫，我買橙我買到啊！你買樓喎，依家你唔係買橙啊嘛？你點買啫？我買唔到，你幾百萬喎，咁樣平幾百萬。我話喂，我銀包，我話佢話好平啫，有幾千萬。我冇幾千萬，我都幾百萬。幾百萬唔得，我真係大睇幾百萬嘅樓。你同李嘉誠講話幾百萬，你供唔到啊？有幾百萬嘅樓佢都俾你，30尺俾個廁所間隔你俾喺度瞓啫嘛，企喺度瞓都當你係。唔合邏輯嘅嗰啲講真。冇啦，2萬點，個個都話，點好咧？點好咧？同埋另一樣嘢係啦，嗱，好多人咧就好多咧啲investor 咧，即係嗰啲叫 TV commentator 即係就話我睇恒指，我會覺得佢跌穿2萬㗎啦，因為個咩交叉線啊啲乜嘢，你得個睇字咯，即係我希望有一日唔會人哋叫我上去電台度，然之後話你點樣睇恒指啊？我大佬我點睇啊？我點知點睇啊？你教我睇啦，我都唔識點睇恒指。你問我話依家20100點，我話俾你聽，如果嗱好簡單，我話俾你聽，恒指我估應該19000至22000之中間就徘徊嘅。咁我係咪有等於有講定唔好講？我19000至22000嘅徘徊，咁你講咩啫？冇嘢都嘥氣啦。所以我同你講嘅嘢，我唔會話俾你聽。依家聽日會點樣行？我連今晚食乜飯我都唔知，我點話俾你聽日個恒指點走啊？你今日你只係用下啲正常邏輯思維啦，話得到俾你聽嗰啲都唔係，即係唔係，即係我都唔知我唔知佢 base 咩啦。嗱，我唔會一樣咧，先平買嘅，調翻轉買，佢話升呢定買跌。嗰啲叫神燈喎。嗰啲阿婆喺電話上咧話嗰隻咁嘅恐怖咧，跟住即刻多數咧都係。所以我咪話呢個咯。都冇機會測咯，係走啊！我琴晚黑都仲見到佢講緊嘢，佢都係一樣，又係着住套搭仔，佢就係一間又係叫嗱咁啊！大家都公開咁講啦，咁我都喺本地證券行做，佢又本地有個證券行做，咁啊大家都係叫競爭對手、同行對手，但係 sorry 啦，我都要插佢，因為你講啲嘢真係好九唔搭八咯，咁我都係唔希望話一日會俾人上到去家庭觀眾打電話上嚟問，我就話。你呢個圖係呢個圖係咁樣天線咗，所以乜，你要做技術分析嘅，我可以分析得好多。你睇下 RSI、MACD 噏大曬出嚟，畫條線俾我睇，你唔好得個噏先得㗎。即係你得個噏嘅話，喂，你個位我都做到，我都講啦，你哋都可以做到佢做個位，咁我點解要你嚟做咩咧？咁所以其實係冇意思嘅係。但係咧有啲咧就真係好好嘅，其中有一個我都要講一講。譬如有一個做地產嘅咧係林一鳴嘅叫做，佢講嘢係好清晰、好宏觀，亦都好有個數據去分析嗰啲。嗰個真係好好，嗰個係我見咁多個裏邊，我都幾中意聽佢講嘢。但係又咁講，人在江湖身不由己，佢係咪真係？佢係咪嘅料係淨係得呢啲咧？咁我覺得應該又唔係嘅，咁只不過係 佢都俾人擺上台。你諗下，佢唔係佢自己申請佢自己上台，係公司拱佢出嚟死啊！你同我出去發揚光大咁樣，咁啊你出去講啦，咁都冇辦法嘅呢啲嘢。佢都可能唔想做。個遊戲玩完點啊？
玩嘅時候都要諗下免費嘅。
即係點咧？
玩完個遊戲。
睇下寫碼係啊。
但係嗰個係我唔知分析咯，而家全部都靠我自己個分析出嚟買佢。
哦，依家就開始嚟啦。So this is actually a very good question. So I hope you guys have a quick break. No, this is actually a learning experience. So I hope you guys heard one of your classmates said something. So you suggest that you have been playing this video the virtual stock exchange game for 3 weeks. And a lot of times when you make a decision, it is more like a random decision, more like a lucky decision, and you don't know what's going on. You just act on behalf of your feelings. You feel that the market is going up, the stock is going up, and then you just buy. The stock is going down, then you short, and then you cover later on, and you do the day trade. So most of the time, you are doing this. But at least I show you one way you can actually implement. One method you can implement. Technical analysis, right? For a particular stock, try to use the technical analysis, try to run maybe the last 5 days and moving average, a simple moving average, or even using the tools available on the internet. So let's say if I always use Yahoo Finance because they got a really good charting device. So let's say if this is actually one way I want to share with you as well. So let's say if I want to consider buying Tesla, and I want to use a technical analysis to do that. So I click Tesla, a particular stock, and then I click the range. So first of all, this is a 2 months investment horizon, right? In this case, I will use, let's say let's say a 2 year or maybe even 1 year, 1 year chart to handle the analysis. And then I use the indicator. Let's say if I believe I want to use the Bollinger Band according to the default. So in this case, I will say, hey, if in early February, it seems like it is going like really high in here. And at that point of time, you may want to consider short at this in this level. And here it's approaching the median line. So you may consider, hey, I want to short the stock, or maybe I want to buy the stock. You act on some technical indicator, and you try it, and you try in a virtual stock exchange, try in your portfolio to see if it actually works. Or you say, hey, I don't like a Bollinger Band. I want to use MACD to see if I can make some gain. Then you need to take up to go to the internet and try to find out what MACD is. It's a convergence indicator, which means that whenever you see at peak something like this, you see this is at peak, it is probably a time to sell. When the purple line cross over the yellow line, there is actually 2 different dates. Then you may want to trigger some signals. In this case here, it's about time to buy or sell. But then, of course, the key is for you to understand what's going on behind this MACD. What is the calculation? What is the logic behind the MACD? What is the long duration and what is the short duration for the MACD? There are lots of indicators here, over 100 indicators, over 20 popular indicators. And there is no way for me to teach every single indicator with you, but you can actually learn it yourself because the formula itself is not complicated. You can go to calculation examples here, and then once you hit calculation example, there will be a technical indicator, a technical analysis formula. And here, these are the 6 or 7 popular indicators. But you said, hey, can I get more? Can I learn more? Yes. You click this website. This particular website will guide you through the 120 indicators that you want to see. And of course, they include everything. But you just need some, maybe 5 or 6 popular indicators. You learn it yourself, and then you can absorb the knowledge. So for me, I'm standing here at the podium. What I'm trying to do is to share the knowledge with you. There's no way I can actually feed you with everything I learned, but I can teach you, I can share with you how you can catch the fish. That is far more important than feeding you with my fish, right? I can show you how the portfolio works. I can actually sell you my product, but that's not the point, because I can sell you the fund because the fund performance is good, but you should actually learn how to catch the fish yourself, so that later on you can actually do it. And this is what the virtual stock exchange, it's going to be helpful to you, because you can try different strategies, different methods, different school of thoughts, and then make a decision yourself. So in your assignment number 2, you can say, hey, I do day trading. You have an investment strategy written up. That's fine. It will be okay. And then you just lay out what is your takeaway. What did you learn? Did you miss anything? What is the learning outcomes? How can you avoid mistakes? How can you grab the opportunity going forward? This is what the assignment number 2 asked you to do. And of course, if you don't stick with the day trading, then you can actually go into the technical analysis. Say you said 20% of my portfolio, let's say $100,000, is going into the technical analysis. I buy, let's say you can in your assignment you said you bought 10 shares of Tesla, 10 shares of Tencent, 5 shares of Alibaba. That's fine. You put it there. You write out, hey, because I use MACD, I lost money. That's good. And then you said, hey, I will never believe in MACD anymore. That is perfect, because you learned something. It may not work for you, but it is fine. So you can use the information you learned in the class to do it. So we have the technical analysis, and then you can try the day trading strategy. And going forward in the next bigger session, it is about the fundamental analysis, and this is far more important than anything else that I'm going to show you, because even for myself, I'm a fundamental guy. So if you ask me, how should I pick up a screen stock? I said, hey, I'm not looking into MACD. I'm not looking into RSI. The first thing I look into is the fundamental elements. And when I said fundamental elements, then you have to break it down into 3 different levels. And these 3 different levels will guide you through how you should create your portfolio. The first level is the macro level, the country level, or the regional level. So at the very, very top is the government, is the country doing a good job. Then the second level is the industry level. I call it sector, because sector is a bigger term. Industry is a smaller term. So sector level. And then the next one, it's about the stock level, company level. With this, you will be able to go deep into the fundamental and see why the company grows and how the company grows. So always remember, when you encounter a professional, so let's say people from say JP Morgan, Morgan Stanley, Goldman Sachs, they always start with the fundamental approach, because this is actually the root of everything. If you want to follow Warren Buffett investment strategy, it is always fundamental approach. So let me give you an example of what happened. During year 2008, in the month of December, the CFO of Lehman Brothers, one of the world's most famous investment banks, the CFO flew to Warren Buffett's home and hand deliver the annual report, annual report at 5 p.m. that afternoon, because it was actually in rush. they need the money right away. And they know that they cannot borrow from the bank, they cannot raise the capital from the equity market, cannot do it from the bond market. No one really cares, even the government. The government said, hey, you're on your own. We are done with the subprime problem. We have to fail some banks, and you are on the top of the list. If you are not able to secure any fundings, we will force you to go bankrupt the next morning. CFO hand delivered the annual report 5 p.m. to Warren Buffett's house. Warren Buffett, for the first time, spent the next 5 hours onto one company's report. That was like, he said that was like the longest time, because usually he understands the company in and out in like 2 hours, 3 hours. That 400 pages report, he read it through carefully, pages by pages. And at the end, around 11 o'clock, that's what he said. He said, no. He said he had no clue what Lehman Brothers does. Even a well-known investment bank, he said his final conclusion was he had no clue what the company does, because the company, Lehman Brothers, did a lot of off-balance sheet leveraging, off-balance sheet investment vehicles. He doesn't know anything about that. I mean, he is already like a financial guru in Wall Street, or like a veteran for like 30, 40 years. And he had no clue what Lehman Brothers did in the past 10 years. And in that case, he said, no, thanks, but no thanks, no money to Lehman Brothers. And then the next day, that was actually Mid-Autumn Festival in Hong Kong. So there was a Hong Kong holiday. And Lehman Brothers, the big headline news, went bankrupt. And it was, everything is about fundamental. Everything is about fundamental. So if any technical analyst or behavioral finance can actually capture that kind of thing, I would say that, okay, you're really good. But then at the end, it is about the company's prospect, company's future, how you can actually go move forward. So one thing I want to share with you, it is actually my investment philosophy. People may ask you, hey, which financial ratio you will look into in order to make an investment? There are actually two things I looked into, and it's not about financial ratio. The first of all is the industry outlook, so the sector outlook. Is the industry growing or is it shrinking? Think about this. If the industry is actually growing, it doesn't matter which player you're investing, right? It doesn't matter which company you're investing. You may want you probably may, at worst case, you may pick up the slower guy, and it is still moving faster than everyone else. So the industry is very important, industry outlook. And then the second thing is the management. Why the management team is so important? Because the management can tell you a really, really good story, but he may not be able to execute that story, which means that he cannot put his dream onto the paper, onto the financial statements. That will be really bad. That will be really bad. In this case, forget it. I mean, during the conference, he may say a lot of good things about the industry, the company's prospects, and even the company strategy. Everything is good, but he cannot execute it. The execution ability is one thing I want to measure. How can I measure that? I will try to look into the company presentation and then try to reconcile that with the financial statement. If the CEO is good in his performance and in his speaking, in his storytelling, then everything he said 5 years ago should be seen on the financial statements in the last 5 years, right? And in that case, then I will believe the CEO can continue to perform well in the future. In this case, with the rising sector growth, like there's a growth here, and then the CEO can actually do the execution with these two elements, then everything will be done. And when you talk about the cost control, revenue growth, and blah blah blah, same store sales growth, all these are just about the execution ability. So I'm not going to be too worried about this, but the two important thing about a company that you need to think of is the sector outlook and then the management execution. If he is a new CEO, it may not be good or may not be bad. Who knows? But one side story I want to tell you is about this Steve Jobs again. So it was actually even before my time. So when Steve Jobs was the CEO of Apple, he was very young. He was only like 23 years old, 23, 25 years old, CEO of Apple. That was back in 1980. But the problem is the entire management team was 40, 50 years old guy. They said that the CFO, the COO, and all the CRO and all the guys over there were old, just like me. And they told Steve, hey, you don't know how to manage your company. Your stock price is shrinking. Now it's $50. It's going to 40. Let us run the company. And they kicked Steve Jobs out of the board. So at that time, since 1990, Steve Jobs was out of the job. He wasn't with Apple anymore. What did he do? He traveled around. And you know what happened with the stock price? All these old guys cannot execute. Don't have the strategy, don't have the plan, and run down the company from $50 all the way to $9, $8. That was the tech bubble. Even at tech bubble, Apple didn't get hit much because it was a company that will be the same thing as Nokia. Anyone heard of Nokia now? Anyone know there is a company called Nokia or Motorola? There's still some people here who still Motorola, but remember this: 20 years ago, Motorola was one of the biggest telecom company in the world. Now it's almost gone. Apple was at that stage, and you know what happened? But nowadays, Steve actually came back, right? Yes, he came back in 2003, and he carried a strategy, a plan with him. That strategy was iPod, not even iPhone. It was the iPod. It was the small device that can carry over 3,000 songs at once. And if you guys, well, probably you guys are still very young kid. When I was my time, I need to carry a Walkman like this big, maybe 2/3 of the size this big, hang it in your belt, put it in your wired headset, and then listen to only 10 songs at once. 10 songs at once. You carry this, and it will be the fashion at that time, 1980. And then later on, they invent the Discman. You have to hold the Discman like this because you cannot hold it like this. You have to hold it like this, and people are walking around on the street like this with the headset. Nowadays, Steve Jobs with the new invention, new strategy. An iPad, maybe 1/3 of this size, and you can actually slide into your pocket. Very easy, and it was crazy. It went crazy. That first model of iPod, not iPad, iPod, and then he had a vision. Can I use just the fingers? I hate all the buttons because after the 10 years of traveling, he said he hates all the buttons. I want a touch screen device for my iPhone, for my telephone. And then he executed that telephone. You know the stock price from it was the worst at $9 and went up all the way to like crazy, like over $1,000. So it was so it was no, this is adjusted, so you cannot actually see this. So now you see it's 18 cents, but it's adjusted because it was really low, and then it was 93, and then it went down to close to nothing in the 985, and then it was actually doing good job, but then it went down all the way to the to here, and it actually did suffer for a bit even in the tech crisis. But then imagine what happened afterwards. When Steve Jobs came in 2003, it was around here. Everyone thought Apple would be a dead company, but with the right management, at 18-cent stock now becomes $149. That was huge. So this is about the fundamental analysis that I'm talking about. From the macro view, sector view, and then all the way down to the company view. So in here, let me go through this. And this is actually what I'm trying to share with you. So tell me, I'll forget. Show me, I may remember. So I show you the Yahoo Finance, but then involve me, and I learn. That's why I ask you to participate in the virtual stock game. If you involve in this particular game, then you know what's in and out about investment. Of course, it's still a very deep, very complicated subject. But if I just tell you, you definitely will forget. So one thing for you to do is to participate. So the first thing is, this is the real fundamental analysis. So whenever you see people talk about fundamental analysis, I'll talk about economy, you know that he is actually starting from the fundamental perspective. It will no longer be guessing Hang Seng Index is going to 21,000 or going down to 19,000. It is not going to be like this. We are going to talk about the Hong Kong economy. To comment on Mr. Paul Chen, our treasurer, the strategy, right? So that's how you should do the fundamental analysis. So let me take a really big snapshot. I mean, probably will not go through every single slide with you. You need to study yourself. But let me go over with you the overview. When you have a global economy, if you remember your economics, macroeconomics 101, CIGX, 4 components, GDP 4 components: consumption, investment, government, and exports. We remember this, then you understand the economy. Of course, with these 4 components, 4 elements, when you drill it down, it will become like a very tiny little bit. And if you ask what moves the market, then I will tell you. Last Friday, it was the consumer purchase index, CPI, in the US that moves the entire global market. Where does that CPI come from? It is actually in CIGX, that consumption element. And within that consumption element, they drew it down to the consumer index. And that's where the components moves the entire market. There was a CPI and there's a PPI, producer purchase index. So if I have to sum up everything, then in this particular session, we are going to look into the CIGX components, and especially the some indicators, some reference points, some index that you need to be aware of. So when we talk about CPI, PPI, you know that it is important. When people talk about inflation, that's important. Interest rate, that's important. Every single indicator that we talk about, usually in the news, in the media, it's all about the economy. So that's the fundamental analysis 101. And then, so when we look at how good an economy is, people look at the GDP, and people look into the stock market. And stock market, you see that the year-to-date performance. This is actually not year-to-date. This is actually, I think it's as of last year. But if you look into this particular, oh, I don't have technical titles. So if you want to look into the so which one is the best market so far? Anyone make a guess?
India.
India? Let's check it out. So this investing.com is another. If you want to get a real live quotes, this is actually the best. So let's see performance year to date. It was actually Italy. Italy MIB is the best. France is actually the second. Euro Stocks 50 is the third, 12% up. And then Spain, so every single European country is actually doing pretty good. Germany, Athens, and then NASDAQ. And then Taiwan, and then let's see Hong Kong. Ugh, it's ugly. And then I see the Shanghai components. And then Hang Seng is right here. Not good. But then it offers you an opportunity because Hang Seng Index has been one of the worst in the last couple of years. India is actually, Nifty is actually the worst, one of the worst. And Nifty 50, that's India. That's Russia. And I think this is Turkey. And it's Brazil. And even Dow is actually not doing good. So this is the European side, and then this is the US side, European side here, and the Chinese, and then the rest. So you can see how we can what's going on. And this is the world GDP guess, and this is actually even in the middle of the COVID. This is how we look at the global economy. And then, of course, when you look at the global economy, you have to look into the exchange rate, the foreign currency, which one is stronger, which one is weaker. And by the way, I know a lot of you guys may have a lot of relatives telling you to buy USD, buy yen, and all that stuff, but I have never ever seen a portfolio manager that can outperform the market in the foreign currency market. So don't do that. You may want the FX set with when you go to a foreign country. That's good enough, but don't ever treat that as a long-term profit making strategy. It doesn't work. So trust me. And then of course, like who is doing what? And the biggest two economies is actually US and China, single country. And China just passed over European Union, EU, for the first time ever historically. So it passed the entire region. So what happened with the GDP? How come now you grow up? How come everyone is attacking China all of a sudden in the last few years? Because they just realized that China's GDP is actually much bigger than they thought. What is the GDP of China in terms of US dollar? Anyone make a guess? What is the GDP for US? So some figure that you want to sort of remember. US is around 21 trillion a year. So every year they make 21 trillion productivity. That's good. China, around 15 trillion. So we are still lagging behind by 6 trillion. So that is more than 1/3. Remember that figure. What is a UK or Germany or France GDP? No more than 5 trillion. So China alone is 3 times bigger than all these companies, all these countries. Germany, France, and UK add up together, they will be big, but then it is not even 5. It is actually 3 or 4. And UK consistently is around like $4 trillion. So when you saw the news, all these prime minister, all these country presidents, they argue with the China. Do you think they have the leverage to do that? President Xi is actually managing an economy much bigger than you think of. And when I saw the New Zealand president trying to argue with China's president, what do you think a President Xi is actually thinking? You are talking to an elephant, Mr. Ant. New Zealand's GDP is not even over Hong Kong. It is not even larger than Hong Kong. How can you have the leverage to talk to a big country like this? So think about this entire scenario. Who is exporting? Who is importing from which country? Who is lagging what product? Think about this. Semiconductor chips is what Chinese are lagging. They cannot, or at least we cannot invent nano 7 or 6 chips. That's our weakness. How can we do? How can we resolve the problem? We acquire. Then what did they do? They pause, they stop, they restrict the acquisition. They force us not they create a law, they write a law and say, hey, you cannot buy our company. So a free market becomes a restricted market. So that's the beauty of democracy, the capitalism. When you see a threat, you pause it, you restrict the action. Semiconductor is a problem. mRNA is not a problem, right? mRNA is the medical technology. So all these things will get involved with the top level country session. But if you are able to make a conclusion, make a good analysis from it, then you will be able to participate in the uprunning sectors. So let's say President Xi knows that we are lagging behind on the semiconductor industry, and they know that the government will pour a lot of money into this particular sector to grow our own machine. What are you going to do? Buy those companies, because you know that the R&D, there must be something coming up. I cannot believe we have like 1.4 billion people, 1.6 billion people, and we cannot form a company that can find a good semiconductor that can actually invent something and outperform the Westerners, right? So this is how you can think about the macro economy. And then for the domestic economy, that's easier to handle, because all you need to do is look into the Chinese or the US or the Hong Kong local figures. So we talked about the stock price, the market. Is it going to be evaluated based on the stock market? Let's say the Hang Seng Index is always trading at a low range, 10 times. SPX is always at a high range, 25 times. So is it cheap or is it not cheap? So people will just based on the market price of the earning. Good thing about this is, in the US, it is easy because SPX is a US company, right? Of course, Microsoft is selling 30% of his product overseas. That will be hard to evaluate the entire US economy. But think about this: people buy Windows, they have to pay the US dollar and buy the Microsoft product, and that will actually go into the US soil, right? The same thing if you look into the China. 99% of the product is actually revenue is actually keeping here. A lot of companies will maintain the geographic revenues within China. And of course, now it's getting wider and wider, but the market, the internal market, is still strong. You can actually grow within ourselves. We don't need to ship our products outside, i.e., we don't need to export that much. We don't need to rely on export. So, as long as we can fulfill our internal consumption, that will be actually sufficient. And then you ask, so what is the GDP component between countries? 70% of GDP is consumption in the US, 70. That is pretty much the max in the entire world. In Europe, you may see something like 50% or 60% in Germany. What about in China? China is only 40%. Imagine if you are running a 40% consumption economy, if it grows 5% more, what will happen? That will be crazy. Even 40% to 45%, that would be a big jump. That's why presidency will always emphasize, hey, we may not need an outside assistance. As long as we can fix our internal economy, we can have a huge growth. So this is how we analyze the internal economy. And of course, you can use a stock market as a reference. You can see that the SSC against the S&P 500 index, how they value. And within the macro point of view, macro level, you can see there's a GDP, inflation, and employment. All these things you heard of from the media, from the news. Every single components will get into the GDP of the economy. So, in these will be the indicators that you should aware of. And I'm not going into this demand supply, but you better read through that yourself, because it is actually going into the macroeconomics 200 level. So you have intermediate macroeconomics. So you have the demand and also supply curve, and where is the demand comes from? Where is the supply comes from? Supply, technology, labor force, demand, consumer market. So how about the government spending, the tax rate, the money supply, and on the other hand, the supply situation. which is the labor force, the economy, and there could be some energy prices and could be some hazards, incremental hazards that cannot be controlled, flood, typhoons, earthquake, and everything. Okay? So all these will contribute to the economy, the economy. And if you remember, I'm not sure how many of you played the game, the Three Romans Kingdom. So when you do this, you have all this strategy play out, and suddenly the game would simulate the earthquake, and then you have to take care of the people over there, and then you shift supply, and then you have to grow you grow your soldiers, you grow your economy. You need the population to grow this. So back in the 1950s, when President Mao, he encouraged the birth rate, making the Chinese one of the largest populated country. So that was good because what he was thinking was, hey, if I get one more manpower, I get one more workforce, and that was good. But then, of course, like there'll be an overbirth, and create a huge burden for later on governments. So that will be a problem. And nowadays, you can see the unemployment rate in China is actually getting higher and higher, and especially in the early age unemployment. What I'm talking about is actually your age. From 23 years old all the way to 30 years old, unemployment rate was shocking. Did the government do anything? I'm sure that they know something, but can they solve it? That will be the next decade's question. So all this will be will tell you how to evaluate an economy, and of course you have to consider the government policy. And government policy, there are two types. Remember this: one is the physical policy. The second one is the monetary policy. Every single country is running the same thing. It doesn't matter it's a dictatorship country like North Korea, or like a capitalism country like the US, the Europe, or even countries like communist country like China. They all have this physical and monetary policy. And that's a Keynes theory, because they said that, hey, it's a balance. You got a physical policy, very easy to understand. Government spending, how much government is going to put in the effort. So Mr. Paul Chen yesterday announced that he is going to spend a lot of monies in the technology sector, which I have no clue because it is so vague and it is not concrete. And then you spend a lot of money in acquiring the labor force, hiring those high-paid individuals. And so those are physical policies: building bridges, tunnels, hospitals, park, and all these is physical policy. Just think about this: when they launch a project, they're not going to hire just 5 people. They're going to hire like thousands of people. It's including not just the construction worker, but it will include some, let's say, the managers, some technology, software engineering, like architects, and all that to actually to build the bridges, right? So in this case, physical policy is very important. And CIGX, that component, the third component, G, is the government spending. That's how the government can react on the economy. If we are going into a recession, how the government can help us? Then they will spend more money than they need, and to stimulate the economy. So this is how the physical policy is. The second one will be well, of course, like a physical policy, when you overspend. So let's say last few years, Hong Kong government overspent because of the COVID situation. They need to push the economy. They need to help the economy. They need to support the society. They need a lot of medical bill payout, and so that's a big problem. And that was the first. I'm not sure that's the first time, but we got the deficit in Hong Kong. So what is the meaning of deficit? It means the government revenues is less than the government spending. Is that a problem? No, it is not a problem. Not a problem at all. As long as you can borrow, it is not a problem. Well, borrowing is not good, right? Yeah, in the Chinese sense, it's not good. But look at the U.S. balance sheet, the U.S. government balance sheet. It has a huge deficit for like, I don't know how many decades, 50 years. This is how they run the company. Do you know what they put in on the US dollar bill, like the note? They put one small sentence, so you can check it out. It says, "In God we trust." So they didn't say that trust the US government, they said, "Hey, in God we trust," which means that every single dollar bill behind there will be a bond issue and they keep borrowing. It is the largest Ponzi scheme ever alive, and it is still working on a legal sense. And that is the US debt market, the US Treasury, US bond market. It is still working. Bonds are trading 99 cents on the dollar, so very, very attractive. It is not like Evergrande, the real estate giant in China, which is trading 5 cents on the dollar, 5%. US Treasury is always a AA, at least AA rated, and it's trading at 99 cents on the dollar. The deficit to them is actually not even a concern. You know, they said, "Hey, it's a problem, it's skyrocketing," but hey, do we care? They just said, "Hey, in God we trust." Well, I guess the Hong Kong government can actually put something like this in whatever we trust, and then they issue the bond. So the bond for Hong Kong, it is not a concern. And let me go over this monetary policy really quick. The second tool a government can do is the monetary policy. So allow me to for 10 minutes. Monetary policy. This is actually the very important tool, and this is the actually much more effective tool. A quick way. It is like a needle injection, a vaccination. If an economy is into a bad state, they can just shrink the money supply or bump the money into the economy, and then everything works out. Fiscal policy may take a year or two to see the effect, but monetary policy, the effect is like immediate. So think about the vaccination injection. You take a shot and then you got immune right away. Very, very quick. And so what will they do? The monetary policy will not be controlled by the government, but will be by the central bank. So in the US, there's a two system. One is the government, the other one is central bank. Everyone works the same. In China, they do the same, central bank and then the government. Their decisions should be separate, but should be aligned and working for the benefits of the society as a whole. Monetary policy is extremely important. And next week, I will explain to you why the cryptocurrency cannot replace this monetary policy and why cryptocurrency may eventually fail. After now, it's sort of falling apart. But from a traditional economic standpoint, because of this monetary policy, and this is the power that the government wants to grab hold on to, they will not release to the public. They will not release to decentralized players. So in this case, cryptocurrency will have some impacts from that standpoint. But we will go over this next time. But remember, we have two policies. We have two tools that the government can use: fiscal policy and monetary policy. And if you're able to observe the difference between the fiscal policy and monetary policy, you can make a good guess on how the economy will look like going forward. All right, thank you very much, and I will see you next lecture. And by the way, remember to get in or tell your friends to get in on the Tuesday and Wednesday tutorial session, because the tutorial session, the first half, we'll discuss about the everything you need to know in the second half, because the second half is the ICA #1, so in-class assessment #1. So be sure to get in the classroom on time and tell your friends to do that, and it should be fairly easy. So you don't need to like really study at this point, but as long as you get involved in the first half, you should be able to understand what's going on in the second half. All right. Good. Thank you. That's it. I need to get out because someone will hit me if I don't.